Hi, I'm Raoul Pal with Real Vision here in the Cayman Islands. I've been thinking through and watching and talking about what's been going on in the repo markets for some time. If you remember, back in about July and August, we started to realise there were some really big structural problems happening when the Treasury's general account needs to be topped up. And that was going to require them to issue an enormous amount of bills which the market wasn't in a position to absorb. We'd already noticed back the previous year that there had been problems with funding and liquidity in these money markets. So I'd been following that story and watching it develop. We started to see some spikes in collateral rates and we saw spikes in the repo rates. And it started to look like it was going to get under tremendous pressure by year end as the Treasury were feeding the market more bills and taking cash out. There was a load of complications to do with inverted yield curves and bank regulations and a bunch of things that meant that this could be a huge problem. Luckily, by the time we got into kind of October, the Fed had figured out what the problem was and they started to massively inject liquidity into the money markets via repos and some sort of thing they called not QE. But most of us don't really know what that is. They were buying Treasury bills, but it wasn't those long-dated bonds we knew from QE. Was this money going into the markets? Some people thought it wasn't, some people thought it was. All we do know is the equity markets went on a tear at that point, and there was an extraordinary period where suddenly equity returns were outsized. They disconnected from the business cycle and disconnected from almost any economic fundamental. Things like Tesla went up in a straight line. So Apple added $350 billion of market cap in literally 2 months. It felt much like the Fed injections of liquidity back in 1999-2000. And although they were different in nature, the outcome seems to have been the same. It may have created, and it's not clear yet, an enormous kind of spike bubble high. It's not clear that that's playing out fully yet because the Fed have now said they're not going to just temporarily be involved in the money markets. They're more likely to be involved in April and then beyond. They may change where they're going to operate on the curve. They're going to be part of our lives going forward. And so is this use of the Treasury General Account, which I think is something that most people don't really understand the importance of. So I want to find out what the hell this is all about, what it means for us. Does it affect us in markets? What do we need to know? I mean, there are questions out there that people are asking. They're good questions, which is, well, if the Fed almost indirectly having to monetize what the Treasury is issuing, can the market absorb larger debts from the US government? Well, of course they can. We've seen it in Japan, we've seen it in Europe, but it depends on timing. Is the market structurally able to deal with it? What's the role of hedge funds in all of this? The Fed told us that hedge funds were a key part of this whole story, but they never told us what and why. So I want to go on that journey of discovery with you and go deep into this topic. It's something we're going to do more of on Real Vision, where we choose a topic, a timely topic, and dig deep, get a bunch of experts to really understand. So you've got more than just a nuance, more than just a one-person interview, but a real journey of discovery that we can all go on together. So I hope you enjoy it and find it useful. So I'm going to reach out to 4 different experts and ask them what their views on the repo market to give us a broad understanding, because there are many views on what's happening and what it means. The first person I'm speaking to is George Selgin from the Cato Institute. What we're going to get from George is the top-down picture, just a basic understanding of what this is all about and what's actually going on. And then as we move through, we'll dig in deeper. George, great to speak to you today. Really excited to understand what your perspectives are on the repo market. It's got everybody's head scratching. People are trying to figure out everything from, is this QE? What's going to happen to the Fed balance sheet? Is it affecting asset price? I mean, so many questions. So I'd love just to kick off with your top-down perspective on what has been going on. I know there's a historical reference that people need to understand, and then what your view on what the situation is right now.
Sure. Well, the current operating system of the Fed, which has been in place since 2008, requires that banks have so many reserves that they actually have more than they need. And so in principle, when that's true, the Fed can control interest rates just by changing the interest rate it pays on reserves, and also second rate it, that it's a little bit lower than that they pay for non-banks. What's happened is that over the course of 2018, beginning of 2017, and beginning of 2018, the Fed was shrinking its balance sheet because they assumed that they had way more reserves after 3 rounds of quantitative easing than they needed to maintain the system and to have it work the way it was supposed to. Evidently, that didn't happen because it turned out that repo rates started to climb above the Fed's target, and notoriously so in mid-September of 2019, when there were some spikes in the rates that clearly caused problems. And what that seemed to suggest is that the Fed had gone too far and the reserves had become scarce, despite the fact there were still over a trillion in excess reserves left in the system. So that's the basic background of what took place.
So the Fed then started essentially adding liquidity to the repo markets to try and offset the Treasury General account as it was issuing new Treasury bills. I mean, asset prices took off on the back of that as well. Do you think those things are linked, or is it separate? Because there's a big debate going on, is it QE or not QE? The Fed has said it's not QE, right, and the smell test of the markets tends to suggest it is QE.
Yeah, I tend to side with the Fed on this issue because QE, there are two ways the Fed could stimulate the market, at least according to the perceived theories. One is by actually reducing its target rates. And it has done a little bit of that, but the other one is quantitative easing. But quantitative easing only works when the Fed is buying long-term bonds, and therefore it's reducing rates, but at the longer end of the maturity spectrum. The Fed purchases that have been going on these last few months have not been of long-term bonds. So they really just amount to swapping reserves for short-term bonds. And independent of any change in the Fed's target rates, that's not supposed to make any difference. That's not really supposed to stimulate markets. It is supposed to prevent a shortage of reserves or make up for a shortage so rates don't spike above the Fed's target, which of course would be problematic. But other than that, it's not supposed to be a source of stimulus, and it's hard to imagine the theory that would make it much of a stimulus if short-term rates aren't changing. If the market is responding to this, what Powell calls a organic balance sheet adjustment, then we don't have a theory to explain why it would. That is a challenge.
And so the Fed have signaled that this balance sheet tightness that's going on by the primary dealers is likely to continue. They've also talked about some hedge fund balance sheets as well over this tightness of liquidity in the repo markets. Do you think this is going to be a kind of a standing repo facility, whether it's just going to be ongoing now? Is there a structural change to how the Fed want to operate to keep the repo markets and the money markets running effectively?
Well, there are three different pieces of Fed policy that are really involved here, three different options. The Fed can expand its balance sheet permanently, which it's been doing. It can have these ad hoc repo operations that it's also been undertaking, or it can establish a true standing repo facility. Now, I know the Fed intends to stop the ad hoc repo purchases, the ones that it has been undertaking where it decides on a daily basis whether to do any more. It's hoping that just expanding the stock of the permanent size of the balance sheet through the outright security purchases will eventually allow it to taper down those repo operations. But that still leaves the question whether it might install a standing repo facility at some date in the future. But it should be understood, the way that facility is supposed to work is not that it's supposed to be there is supposed to be activity there all the time. There aren't supposed to be regular repo operations. It is meant to be just a standby facility, the very presence of which provides some assurance to banks that they can always go there if they need to, but that they don't use on a regular basis. So if the Fed goes that route, it still won't have everyday repo interventions as it has had in the recent months, but it will have a facility that can kick in on exceptional occasions when demand for reserve spikes for any reason.
Is this process just because of the Treasury General Account and the excess bills that came into the market and taking out the liquidity from the market? Is that what the Fed's trying to see through and get to the end of before the Treasury General Account gets drawn down over time again? What stops them continuing?
So there are three factors that came together to cause this reserve shortage that the Fed's now trying to address. One is its own unwind that I mentioned earlier, where it from October 2017 to about a year later, they were contracting the balance sheet and reducing reserves that way. The other was growth in the Treasury General Account, which also reduced reserves. That account, it's gone up to over 250. It's heading towards $300 billion. So that's a drain on reserves. Finally, there's the foreign repo pool. That's another drain on reserves. So all three of these things were causing the supply of reserves to shrink. And the Fed's present purchases are meant to offset all of them, have to offset all of them if the Fed's going to solve the problem for any length of time. So you can't really say that the Fed's expansion is to address any one of these factors. The other thing that's been going on that was a source of problem is the government has been issuing bonds. And the liquidity requirements of the dealers have gone up because of those bond issues. So you've had reserves being drawn down by those three factors and increased liquidity needs as a result of the dealers having to maintain inventories of bonds that they're asked to purchase and then sell. And finally, you have all the liquidity requirements from Basel and otherwise that also are generating high demand for liquidity compared to in the past. So it's a confluence of quite a few factors that the Fed has to try to somehow make up for in the next few months.
And after that, do you think that some of these bills, because they're quite short term, they're just going to roll off them, or there's been talk about extending it out into 2-year notes as well? How do you think the balance sheet's going to play out?
Well, the balance sheet's going up now. It's not going to go down again. It's never going to go down again. So when these bills roll off, the Fed's going to replace them because unless it does something to curtail the total demand for reserves or to otherwise increase the supply, it has to permanently increase its balance sheet or we'll have shortages again. If they could get the Treasury General Account back down, or if they can permanently reduce the foreign repo pool, they won't have to keep the balance sheet as large as if they fail to do those things. But so far, the Fed has only taken a somewhat modest approach to reining in the foreign repo pool. It did change the rules in a way that has helped a little bit, but it's not clear it'll help for good. As for the Treasury General Account, nothing is happening to reduce that. Indeed, the Treasury is now talking about maintaining an even larger balance in the TGA than it has been doing so far. One wonders whether the Fed and the Treasury are actually talking to one another because it's as if the right hand didn't know what the left hand was doing on this.
Interesting enough, one of the theories that circulates around is that Mnuchin wants to force the Fed's hand to inject liquidity in the repo markets because whether it's a real flow-through effect or just a Pavlovian effect, the equity market went up, which seems to be primarily a politically driven thing. That was a theory that goes around. I thought it was interesting.
Yeah, I can't speak to whether there's anything to that, but I really think that the markets, if there's any connection between what markets are doing now and Fed policy, it's more likely to be based on the fact that the Fed is not in any mood to raise interest rates, and the spiking of the rates kind of underscored, and the efforts it's taken to combat that kind of underscored for people that the Fed is not about to tighten. That's a different avenue for encouraging stocks than quantitative easing or whatever you want to call the Fed's balance sheet expansion itself. I think it's this first avenue that's really mattering. People are just rightly perceiving that the Fed is not going to be raising rates anytime soon. That, of course, will boost the stock market.
So do you think, obviously you think it's more of a technical issue than it is a system-wide issue, I presume. If you agree with that, obviously there's a regulatory problem that's here somewhere that's at the foot of some of this. What are your thoughts on that?
Well, I think it's a technical issue, but it's more than a technical issue. And it's more than a regulatory issue as well. I think the big question here is, after all the trouble the Fed has had keeping this new operating system functioning smoothly, whether they should reconsider the possibility of changing from an abundant reserve or floor system, as it's called, to a corridor-like system. In fact, they've kind of had a corridor going. It's just a really dirty, unintentional corridor system where they've got all these different rates, et cetera, and they keep having to tweak them. So I think the big question is whether they really want to keep going this way. It has to be kept in mind that back in 2018, I think it was, when the FOMC first decided among themselves, well, we're going to stick with this post-crisis system after all. They said in the minutes, but of course, if it turns out to call for a lot more reserves than we presently think is necessary, we're going to reconsider. Well, it turns out it's calling for a lot more reserves, and we hope that that there will be some end to this expansion that will accomplish what the Fed wants it to accomplish. But since the system seems to need so many more reserves than was anticipated, they should stick to their promise back then, even if it was a promise only made in among themselves. But it's now public because we know what they've said. They should stick to that and reconsider the whole arrangement, because it's turning out to be a mess. And it's not a healthy situation to have an interest rate setting arrangement that causes so much problem, so much trouble. It has to be jury rigged, it has to be toyed with, it has to be tweaked. It's time for them to reconsider that.
Now, if the market is struggling with liquidity at the primary dealer level, and we go to a recession where the government needs to issue, or the Treasury needs to issue significantly more bonds, but that's usually what happens, is the market able to deal with it?
Well, I think in that case, we will see genuine quantitative easing. That is, the kind that nobody will be able to doubt is or denies quantitative easing. Particularly, that will be the case if interest rates can't be lowered much more, and that's a very possible contingency. There's now only 1.75 or fewer basis points by which they can lower their policy rates. So they will have resort to quantitative easing, and they will probably be buying long-term bonds, and presumably, therefore, the Treasury will have no problem unloading the bonds in that situation. But of course, quantitative easing is controversial even as a device to fight recessions with. There's still some doubts as to how effective it was before. Indeed, I'm worried that they're going to resort to quantitative easing even if there isn't a recession, but because there's a lot of pressure to use the Fed's balance sheet to support various fiscal programs, and that pressure may be mounting in the future. And the one problem with the present system is not only that it doesn't work well, but that it lends itself to quantitative easing even when you don't need it. That's something you couldn't do with a corridor system. In a corridor, you get quantitative easing when interest rates can't go any lower, but you can't do it otherwise. In the present system, in the floor system, they can resort to it any time for any reason.
Very interesting. George, listen, thank you very much for your perspectives. I think it's very good to set down the top-down understanding. As I said, I'm going to speak to a few more experts in the field to get some different nuances and see where we get to. And hopefully you'll be able to watch the piece and we'll get some broader understandings of what other people are thinking here, because it's a fascinating time and something's broken and we need to figure out how serious it is, I guess.
Well, I look forward to seeing what the other commentators have to say. I hope we don't disagree with each other too much. and that among us, we're able to put some pieces of the puzzle together.
Perfect. Great. Again, George, thank you ever so much for your input.
You're welcome, Ro. Thank you.
So now we've kind of got the basic understandings right, I think we want to get some understanding of how this affects markets, how it affects us, and maybe start asking some more of the complicated questions on what this really means. And again, I'm not expecting full answers because none of us really know, and I don't think even the Federal Reserve knows. So all we can do is ask the right questions and try and figure out how this might impact us. So I'm going to ask George Consalves. George's been on Real Vision a number of times, and he's a really good expert on this kind of thing. And I want to think through it with him, have a bit of discussion and debate, and see where we get to. George, finally, we get face-to-face, but over Skype, so it's not quite the same thing. Listen, I really appreciate you've been on Real Vision a couple of times, giving your perspectives on what's been going on with regards to repo, the money markets, and the markets in general. So I wanted to pick your brains about the repo situation. We've heard about, from a kind of economist perspective, what it's all about. How do you see it, and how do you tie that into market? Just so people can understand, okay, how does it affect us? What does it really mean?
Yeah, I mean, at the end of the day, if you think about repo and just the building blocks of the financial system, it really kind of starts with the risk-free rate and the ability to kind of know that you have the ability to fund your position. So looking at it from a pure market perspective and realizing what happened in September and the sort of volatility that could have gotten worse. I mean, obviously the Fed stepped in. It really starts with reducing volatility, reassuring funding ability, and then having ability to trade and actually transact. And I think what a lot of folks will kind of not connect the dots well, especially coming from the academic side. They fail to realize that people do put on trades on the levered side. They borrow money to put trades on, and they think that everything's kind of uniform, and it's not. So I feel like that's really the key difference between what the academics are viewing this repo issue that took place in the last 3 to 6 months. And I think even the Fed, obviously, really run by academics, initially took that stance as well. I think lately, though, they've been starting to really put more of their arms around it. They have a better grasp of that this is a serious kind of market structural issue, a liquidity issue, and it could have knock-on effects. And so I think that they're starting to get a better handle. They haven't really fixed it yet, though.
What do you perceive the problems to be? Because there's a lot of different opinions on what the real problem is here. I mean, obviously there's regulation issues, there's the kind of reserves that the people have to hold. There was the same time that the Treasury General account had to be
replenished.
There's a bunch of things. So how do you frame this whole thing in your mind when you're looking at it?
I mean, I think you need to really go back and go really back to the financial crisis and really go back to why do we have these regulations in the first place and think through that the Fed in many ways became like a sieve, right? It became like a shadow banking counterparty for a lot of different investors during the height of the crisis. Then they swapped all of those assets and started buying treasuries and mortgages and then pumped in all these reserves, which kind of papered over everything. There was so much liquidity floating in the system that bank managers really didn't have to actually do their job as they used to. I mean, they were just so flush that they were hitting all their ratios. All their liquidity ratios were working. And over time, as the Fed, I think actually started to forget that they actually injected all this liquidity, got confident that they could actually reduce the liquidity through quantitative tightening. And while that was all transpiring, you also had other things at play too. You have the Treasury General account and how that used to be much smaller pre-crisis. And I kind of compare it to like the Strategic Petroleum Reserve, like the SPR. It's good to have all this excess liquidity just in case, because you don't know what may happen to markets. And I feel like that's like the Treasury side. And then you have the banks themselves that are hoarders, and they want to have excess liquidity too, because they're worried about counterparty risks and other issues that could still come to the markets. And I think you start to add all that together, and the Fed was, view the stability that was happening in the marketplace as a time for them to drain liquidity, and they were complacent. And I think that they failed to realize that the stability that they created led to instability once you got to a very fine line between how much people actually wanted reserves versus what was available on a given day. And I think that that's still unresolved. I mean, I think the Treasury General account has gone up to the maximum size. That's not going to be an issue going forward unless we have another debt ceiling crisis. But there's foreign central banks that keep cash at the Fed too. They weren't there pre-crisis either. And you have the banks that are really needing to hold all this extra cash. Now, That's purely the mechanics of it. I mean, I think what sometimes also people fail to realize that during this time period, the last 10 years, we further got dollarized. I mean, the world is even more dollarized, and there's a lot of dollars that are created overseas. And so the repo market has shrunk relative to the size of the treasury market.
Well, also the foreign repo markets aren't fungible with the US any longer because of regulation. So Deutsche Bank funding its dollars in Europe has to stay in the Eurodollar market. It can't access them via its operations in the US any longer. So it's kind of screwed up liquidity everywhere.
That's right. And it creates like this Chinese wall kind of system. Like it's almost like there's like $2 markets. And I hate to say that because you can also parallel it to onshore, offshore, renminbi, right? You kind of compare it to that concept. I mean, granted, the US dollar is everywhere, so it's not that restricted. But it's almost like we have $2 markets that have created post-financial crisis. And when you're short dollars, you'll kind of bid for it at whatever price you need to kind of get your access to liquidity. All of these pieces came together in a perfect storm in the fourth quarter of 2019. And the only answer the Fed has at this moment is to flood it. Just flood as much liquidity as possible because they don't know what the right solution is. And they've seen it at least work in the past that when they do versions of liquidity injections, but they don't want to call it QE, but when they do that, at least it calms down things. So now they've calmed down the money markets. I mean, look, this past week they raised the overnight rate. I have a theory around what's going on there. But all of this is still Band-Aids. It's not fixed.
Do they even know what the problem is? I mean, one of the things that came out is they were concerned about some of the big relative value hedge fund fundings as well. And because they're acting now as a liquidity absorber within the primary markets, essentially because the primary dealers play a smaller role. So now we've got the kind of private sector in the hedge fund, the leverage sector playing a part in this. What the hell's all that about?
Yeah, look, obviously, dealers have a lot of counterparties, and there was at the beginning of 2019, and I really thought that the sponsored repo would create additional liquidity, and it has. But the problem, which I failed to also include in my list of what drove us here, was that we're issuing $1 trillion of debt. I mean, net debt, where there's so many more treasuries now hitting the system. This idea that, we can just expand, forever and not actually have an impact on the footprint for those that will provide funding for those securities, because a lot of people buy treasuries on the margin, not just with actually sourcing proper cash. And the banks themselves, their repo positions went from like 400 billion pre-QT to like a peak above 800 billion. And if you include all kind of repo markets, it's back at the peak. I mean, it's over four and a half trillion. It's still small compared to the treasury market, but it's back at 2008 peaks, the overall repo market. And banks led the charge on that. And I think that they just said no mas. They got to the point in September, October, that the Fed had to create additional balance sheet, basically.
Is this a function of leverage? So, and then because the reserves are being used by the banks, there's just not enough. I don't know, it feels like you can sustain a large amount of leverage, but when anybody asks for some cash out of the system, the whole system breaks again. Is that anything right?
No, look, I think there's a combination of the leverage, liquidity, and the need for good high quality collateral. I mean, I think there's still, there's a shortage there. And even though the Treasury is issuing all this debt, there's still a hoarding effect that's happening. So I think it's a combination of all these things. But I do believe that the balance sheet availability or the lack thereof, it does have knock-on effects to other asset classes. And that's, I think, where the Fed started to make that connection. It clearly happened in the fourth quarter of 18, and then they got their arms around that and started to lower rates and stopped QT. And then eventually they thought they had fixed everything, and this came out of the blue in September. So it's bank balance sheet availability, it's leverage within the system that's still running really high, and they need to let it run high. Otherwise, there's going to be a reprice of assets. I mean, there's going to be the same amount of bonds everywhere, but they're going to go from a price of 130 down to 100. It's going to hurt actual capital somewhere.
Okay, so then it does kind of help keep asset prices elevated, because we saw after QT, suddenly asset prices didn't look so good and they had to step in and cut very quickly. Then they've had the repo market issue. So if you were to take away some of either the collateral or the liquidity, basically there's a repricing of assets. And that's what you think they're trying to stop in the end? I mean, can the market operate normally, or is we're now in a situation where it can't?
Well, I mean, so this is where they're trying to be cute, or some within the Fed think that there's the ability to create like these standing repo facilities. The issue that I have in general with these sort of things, one, you're further entrenching yourself with the market, so you're kind of getting more into the manipulation of markets, or you're becoming the market in that sense. And especially if you don't charge a penalty rate. I mean, I'm all for central banks providing liquidity when it's needed, but not at market rates. And basically, right now you can go to the repo program at the Fed and basically get the same rate as the street. So what's the point? I mean, they need to have it as a penalty rate, but then they know once they start doing that, then there's going to be that knock-on effect to other financial assets. So I feel like what's going to end up happening is there's going to be all this debate, and in the time being, we'll probably see macro conditions continue to worsen, and they'll have an excuse to jump right to QE. Like this idea that they're going to fix it with like a nice, elegant solution, it's going to be like they won't have time to just fast forward and go into a massive QE program.
Do you think? And I agree with that view, and I think they're going to I think they'll cut rates to zero and then go to QE, and it's going to happen pretty quick, for a number of reasons, for the economy, for liquidity, So the next phase, you think, is they've already been talking about moving out to 2 years, and they'll run the bills off and then exchange it into 2 years. What is their next plan before they go to the full QE? So, this will be definitely not QE really, but it's 2-year notes,
Yeah, exactly. You're now officially sitting on the curve. So I feel like, look, they're trying to treat this as so technical in nature that we should be bored by it. So you look at it like the way that he described, this 5 basis point adjustment higher in the IOER, it's just bringing it back into the middle of the range. Okay, what does that even mean? And so they know that the markets are watching them very closely. If they get rates back down towards the zero bound and potentially go through it, which is a whole other topic, but they're going to need to create some sort of kind of tiering effect. In many ways, what the European, what the ECB did, Bank of Japan has a version of this too. Once you become like ZIRP or NIRP, you need to have tiering, and I think that the Fed is starting to get us ready for that. Number one, especially when you flood it with so much liquidity from QE. When you start to buy out the curve, and you start moving the rate levels down to where they're going to have to go, then it's going to be QE, and at that point, they're going to have to just call it QE. But I guess, like, what was your question? Was basically,
so they're moving to 2 years, and you don't think so? Firstly, what I want to know is, are they going to roll off any of the balance sheet when these bills are mature, or are they just going to go straight into 2 years? While we're waiting for the recession to come along?
That's a good question. So this is where I think I was trying to make the connection of them being cute with raising the IOER. So they're trying to make this sound like this is very technical in nature. So they're going to taper the T-bills, but then they're going to say, look, we cannot have such a heavy footprint in T-bills. We're going to go out the curve, but trust us, it's only technical. We're just doing this so that we're not, impacting the overall dynamics of T-bill market. And they can maybe get by with that if they call it the short coupons and just any off-the-run treasuries, maybe not the primary, on the runs. They can buy all the securities between the 1 year and the 2 year sector that are off the run, kind of like the orphan side of the bond market. And I think they can maybe get away with that. But while they're doing that, I mean, I think that other things are going to be working out at the same time. So it's going to be technical, but the risk they have of being like so technical, we all know, even if the Fed won't admit it, the stock market believes they're doing a version of QE. And so it's going to feel like tightening. If you go from buying 60 to 100 billion per month through the combination of T-bills and repo, and you go down to 15, 20, it's going to be like a stall speed. I mean, the equity market's going to feel it in April, May, June. That's why I feel like it's hard for that to even happen, because by then we'll know the macro is probably bad. If the macro is bad enough, by June we should know if things have decelerated enough, and the Fed will be watching it real time too. So they'll just keep punting like they did this time, where they punted it to April. And then at the March meeting, they'll look up and say, oh, wow, there is an actual impact from this coronavirus. It's starting to actually impact growth, and the U.S. was never going to reflate anyway. And they start to kind of make an excuse to keeping it on until July. And so I feel like the easiest thing to do is they will probably give us a tapering plan, but slow it down and then have like an intersection into the summer. And at that point, they can just dial it up. And if they're only doing 20, or they're going to say they're going to do 20 and the market has a hissy fit, then they can just go to 50 or 60 back up again. So I feel like it's like this calibration. It's a calibration thing that I'm having a hard time, I think, maybe explaining. But
and I think they're going to have to steepen the curve somehow. So my guess is they have to cut rates to zero. I mean, I can only see this as upside for the bond market. But I look at it and think, well, they're going to have to try and steepen the curve. So the first thing they have to do is cut rates to zero or somewhere close, 25 basis points, and then see from there what they need to do to try and manage the curve to inject some sort of velocity of money back into the money markets, which is ground to a halt because of all of this stuff.
Yeah, exactly. But this is where I'm having a hard time getting like the right trade on or the view of how to manage the next 3 to 6 months. Because if it doesn't get that bad, they're going to believe that they actually dodged the bullet. Then they're going to go slow about it, and they'll do this sort of tapering. Then if we do see a correction and it's severe enough to catch their attention, and we get proof that this is a real economic slowdown globally, they're going to cut. Then in the midst of their cutting, it's going to be like 25, then like they'll do the rest of it all in one shot. It's going to be, they're always going to be a very like put their toe in the water first. Then if they realize it's not working, they go fast. So it is definitely bomb bullish for 100%. And with the aim of it being to steepen the curve, I think it's going to be too late by the time they get everything lined up.
George, perfect. That was really, really useful for us to get some sort of perspective of what the hell's going on and how it knocks on. Because again, a lot of people don't really understand how it knocks on, what it means, because it is complex and the Fed tell you it's technical, but there are some real implications in here. And there's a real tightness of money that's around that the Fed had to address. And that will affect, we've even seen buybacks lower and stuff like that. It will have knock-on effects if there's a tightness of money. So we'll see how it develops because it's interesting. And I think you'll enjoy watching this piece as well when we put all the 4 different viewpoints together to see, okay, where's the nuance in this and what are the angles we haven't covered yet? So we'll see from there. But thank you ever so much.
Thanks, Raoul. Look forward to it. Appreciate it.
Perfect. So it's interesting to see George's perspectives because he's starting to see some impacts here on markets, and I think he's not clear that this is a solvable situation that's not more problematic than it first seems. So we'll have to wait and see. But let's ask Scott Scrim what he thinks. Scott is in the weeds, he's in the trenches, he's a money market dealer. He's part of a brokerage house that gets really involved in the action. So he can see who's buying, who's selling and what's going on. It'd be really interesting to see what his perspective is on this whole thing. Scott, great to speak to you. I really wanted to get your idea because you're kind of more in the trenches on this and less of an observer and more of somebody who's actively involved. Talk to me a bit about how you perceive what's going on in the repo markets, maybe a little bit of the history, but also what you think it's all about.
So the problem in the repo market or the repo market panic, and I assume you are referring to the event that occurred in September of this past year.
Yeah.
Everybody seems to quote that there is a problem there, but I don't know how many people feel like they really know what really occurred or what the solution was. So let me start from the beginning. And if you want, stop me at any point and ask another question. I'm happy to answer whatever you'd like.
Great.
So back in September, and what's interesting too is that, depending on who you ask and what their role is in the market, you really get a different response. And I'll try to...
What's your role, just so everybody's aware?
So I work at a company called Curvature Securities, and we are a broker-dealer that is completely devoted to securities financing. We're kind of a specialized broker-dealer. It was an idea of our principals a few years ago that there were going to be changes in the repo market, and bank balance sheet was going to become a little scarce, and spreads were going to start to widen in the repo market. And our investors had some good insight and foresight to set up a broker dealer that only does repo, just finances securities. So I run a group. There's 3 traders, including myself, in my group at Curvature, and we finance U.S. Treasury securities for our clients.
Excellent. Okay, so from your perspective, let's go, because it's going to be very interesting because you're right in the trenches.
Exactly. So we're in the trenches. So we're speaking with the hedge funds, the cash investors, the banks, the broker dealers, the regional broker dealers that are involved in the repo market, and we're making markets for them. So come to September of 2019, all of a sudden rates just started backing up. They, went from, let's say that they're supposed to trade around 2.5%. And they just started creeping higher on that particular day. That that Monday, and it became even more of an issue that Tuesday, September 17th, I believe. So what was supposed to happen was there were Treasury settlements. There were new issues settling some middle of September. So you had 3-year notes, 10-year notes, and long bonds. You had a tax payment date. And basically you had normal occurrences in the market that have been going on for years and years and years, which have not caused extreme volatility. Those events occurred and there was supposed to be no problem with it. But as it turns out, rates just continued to go higher and higher and higher. So rates went past 3% and 4% and 5%. They actually peaked at 9.25% and then started to drop after that. And by the end of the day, rates were actually back to levels that were somewhat normal back in the 2 handles. But what could have caused all this extreme volatility? And there had to be a reason for it. So now if we take a look at it and we look at, if we ask different players or participants in the market, they generally have different reasons for what happened in the repo market. So first off, let's take Federal Reserve officials and government officials, regulators. I think they look at it as more of an academic point of view. So they're looking at it as the Federal Reserve was unwinding the SOMA portfolio and was, which the SOMA portfolio had gotten as large as about...
Explain what SOMA is to people.
SOMA is the portfolio of securities that's held by the Federal Reserve. Back several years ago, in order to ease rates, bring rates lower, the Federal Reserve had started a QE, quantitative easing program, where the Federal Reserve bought up a lot of Treasury securities that had been issued in the market, and they had accumulated a portfolio of $4.4 billion approximately. Back a year or so...
$4.4 trillion.
$4.4 trillion, correct. It's so easy to mess up those billions and trillions these days.
What does it matter anymore? It'll be quadrillions soon.
It's big, let's just say. So as the Federal Reserve had decided that they were, instead of adding liquidity to the market, they started taking liquidity out of the market, one, by raising the federal funds target range, and two, by putting some of those securities back in their market. In other words, unwinding their portfolio, which some people called it quantitative tightening, which is technically not correct. It's really QE unwind or QE runoff. So they let securities in their portfolio mature rather than reinvest the proceeds. Mm-hmm. So the size of the SOMA, the Fed SOMA portfolio, had decreased substantially, and Federal Reserve officials, regulators, government personnel saw it as I said, somewhat of an academic issue that occurred, where bank reserves were lower than they should have been, or bank reserves had declined enough so that there wasn't enough liquidity in the market. So that's potentially one cause. Another cause, if you ask top bank officials, they tended to blame it on new regulations. And so, for example, with Dodd-Frank, there's in Basel III, which affect banks, there are leverage ratios and liquidity coverage ratios and all sorts of new ways of regulating bank liquidity. And I think a lot of the ideas coming from the top bank officials were that CEOs and such was that that there was cash that could have gone into the repo market, but it was prevented because of the new regulations.
And that was people had to keep higher excess reserves.
Exactly. So now we kind of have three things so far. We have, the initial issue was new issuance and tax payment date in September. We had the runoff of the SOMA portfolio. We had bank regulation, and there's another part of it that's not really discussed. And I would say, from someone that's in the trenches of the repo market, this kind of makes more sense to me. And I think it's a matter of timing. And there's a timing issue in the repo market, whereas a lot of the large players, like the hedge funds, that own a lot of treasury securities, tens of billions, maybe hundreds of billions. They want to finance those securities first thing in the morning. So the repo market opens at 7 o'clock in the morning. Most of the hedge funds with long, large positions that need cash, they need financing, they are in first thing in the morning to get their cash and finance their positions. Whereas a lot of cash that comes into the repo market all day long. So there's cash that comes in the morning, but there's also cash investors at banks that they don't come in at 7 o'clock in the morning. They come in at 8 o'clock or 8:30. And then you have cash investors from the Midwest, and you have municipalities and states and cities and money market funds that are long cash. And they're not coming in at 7 o'clock New York time. They're coming in at 9 o'clock, 9:30 New York time. And then, of course, you have West Coast cash that comes in potentially around noon or early afternoon. So this is an aspect of the problem that hasn't been discussed because I would say it's hard to figure out what the solution is for that. But that is an issue in the repo market, is that the people who need cash are in first thing in the morning, where the cash comes in throughout the day.
So one of the things I've been thinking about, I'll pick your brains on this because you'll probably see it, I have a feeling that the balance in mutual funds has probably fallen with this massive equity rally and the shift towards indexation and stuff like that. So people have less cash. So is there less cash supplied, let's say, from the pension system than is required from the leverage players and needed for the bank? Is there a cash mismatch that's going on within this?
Money market fund cash that was coming into the repo market had been increasing all of 2019. There had been more and more money market cash that was getting invested in repo. Now, it's hard to find a good source of information for that. I have a website that I look at. I could probably look at it right now and see where money market fund cash is, but that's a factor in the market. I don't think that caused the repo market panic of September 17th, but that is a factor in the market. And what you have to look at in the repo market, and this is more maybe repo market theory. I don't know if it's as good for your program, but you have to look at the repo market as it's a balance between supply and demand, as all markets are. But in the repo market, there's two factors leading to the supply and demand. There's supply and demand of cash, and there's supply and demand of securities. So, for example, more cash comes into the markets, that's more liquidity, helps push rates lower. On the other side of the equation, let's say, the US Treasury issues more Treasury securities, that puts more supply of securities in the market, and that tends to push rates higher.
Somewhere within this, it feels that there's a velocity of money that doesn't function, whether it's a timing difference, as you said, but something that forces the Fed to come in and intervene, not just in September, but all the way through to today and going forward all the way through to April. So it doesn't sound like it's a one-off, and it doesn't sound like it's necessary just that funding window. There's something more structural at play here. Is it to do with excess leverage, not enough collateral? Is it to do with how the banks are using their cash reserves? What's your perspective on what the really big picture in this is?
I think the repo market, if you look at the repo market through the end of 2019, it's kind of like the madness of crowds. So there was a lot of nervousness that repo rates could basically spike up again. And people were very nervous about that. And they were looking for periods of time when there were changes in supply and demand for cash, which can be on a month end, when new treasuries settle, when there's a tax date. So throughout the rest of 2019, after that repo event occurred, the repo market and traders in the market were very nervous that there could be another rate spike. Now, of course, the Federal Reserve came in and started RP operations. So in other words, the Federal Reserve would do overnight or 1 week or 2 week term operations where they would take securities out of the market, put cash in. That was a good kind of short-term solution for really calming people's panic about there not being enough cash. But basically, there was plenty of cash for the rest of 2019 in the market every day, and repo rates barely spiked any higher, even on year end. But there is a consistent amount of nervousness that there wouldn't be enough cash.
Well, but people did draw enormous amounts out of the repo market, right? There was like 160 odd billion being used a day. So I mean, there's clearly a need for it. It wasn't like it was a normal functioning market.
Right. So what's interesting about that is that, yes, on year end, there's a total of about $255 billion that the Federal Reserve had put into the repo market via RP operations, let alone the amount of bills, treasury bills, that the Federal Reserve had purchased through, quote, QE Light, where the Federal Reserve came back and started buying securities for the SOMA portfolio again. Now, here's the thing, which it doesn't, when you look at it how you do, where you say, okay, right now there's roughly about $170 billion in Federal Reserve cash funding the repo market. So in other words, RP operations outstanding today is about 170 billion. And why does the Fed still need to put $170 billion in the repo market where they didn't have to do that 6 months ago? And they've already bought a lot of securities via the QE Light program. So here's the answer to that, is that the Fed has somewhat shot themselves in the foot by being so aggressive with RP operations. So what had been going on during the end of 2018 and throughout much of 2019 is that all the U.S. Treasury issuance, so if you look at the U.S. budget deficit and it's $1 trillion, let's say, that's $1 trillion worth of new Treasury securities that are being issued into the market every year to fund that budget deficit. So you consistently have more and more U.S. Treasuries that were being issued into the market all through 2019. What had happened to repo rates during that period of time is that repo rates had been creeping higher. So let's say that the federal funds target range was 2.25 to 2.5, and the federal funds rate should be about in the middle of that range. And let's say that normally the repo rate, the overnight repo rate, would be around the middle of the range. Overnight repo rates throughout 2019 had been creeping higher, and they had been at the high end of the range. And basically, overnight repo rates needed to draw in cash from other markets, for example, like the Fed funds market, or cash that wouldn't have necessarily gone into the repo market because the repo market had to fund this large treasury issuance and budget deficit. So you had back, at the end of 2019, you had repo rates at the very high end of the range because the repo market had to attract cash from other markets into the repo market to fund all the securities. So here's what happened. So once the Federal Reserve came in and started pumping their own cash into the market, then repo rates started moving to the lower end of the Fed funds target range and much closer to IOER and Fed funds. So as repo rates declined within the range, they were not as an attractive alternative investment for other cash investors. So a lot of that cash has left the market. So whereas now that the Fed came in to fund the repo market, other cash that was in the market has left because rates are relatively too low, because you have the 1,000-pound gorilla in the room pushing.
What you're saying is they can't stop this now.
Well, what's very interesting too, and I've had this discussion with a couple of people, it's kind of like a circle. So right now, the Federal Reserve has put so much cash into the market that they've driven rates lower. And for the Federal Reserve to stop RP operations, that means that rates need to be higher. And basically, for the Federal Reserve to stop operations, they need other cash investors to come back into the market. For other cash investors to come back into the market, rates need to be higher. And for rates to be higher, the Federal Reserve has to get out of the market. So it's one big circle.
And the net result of this, to me, I think, the Fed are going to part of this problems are caused by the inverted yield curve, and the relative attractiveness of certain assets in that way. Do you think the Fed are going to have to cut rates because of, well, the economy looks like it's slowing right now from my perspective. Do you think the Fed have to kind of cut rates, try and steepen the curve, move out along the Treasury curve and try and get this all kind of ironed out?
I think the Federal Reserve is doing what they normally do. And that's a QE program, that's add liquidity. That's kind of the role of the Fed. When there's a crisis, when there's a lack of liquidity, they figure out ways to come in and put liquidity in the market. However, I think that, as we said at the beginning, the Federal Reserve views it as bank reserves. It's a very academic way of looking at it. Me personally, I think it's a combination of a few things. So it's U.S. Treasury issuance. When you keep putting $1 trillion of new treasuries in the market.
So what you're saying is they can't run as high a deficit in a normal market conditions. In a recession, you probably can because you've got buyers from the pension system and everybody else. But in a normal market condition, and with a flat yield curve, nobody wants to own the long end, right?
And think of that too. Just when the Federal Reserve was tightening rates, unwinding the QE portfolio, the Treasury kept issuing more and more Treasury securities. So there's a lot of things that were happening. So I would say if you looked at the repo problem, it's that there's a lot of the things that we discussed all played a factor. Me personally, I think that the QE purchases are going to help. Actually, here's another point that's important too. I think in 2019 we had a laissez-faire Fed. So for example, repo rates, not last year end, but the year end before, the year end 2018, repo rates had actually spiked higher on that day too, up to 7.25% roughly in there, maybe 7.5%. But it wasn't really noticed as much because people said, oh, hey, that's year end, that happens. However, as looking back, that was clearly a warning sign that during times of less liquidity in the market that rates could spike. Now, what happened was market participants were calling for a Federal Reserve RP program, some automatic mechanism for the Fed to put cash into the market. There was discussion about it, but the Fed didn't really do anything. They didn't come in 2019 until September to do any RP operations. So they're very hands-off. I think that the Fed probably could have, and of course, looking back is hindsight's 2020. But had the Fed started coming in and doing RP operations, in a reasonable manner, in a reasonable amount, that might have helped out the issues in the repo market all year. So with our discussion, we had somewhat of a laissez-faire Fed. We had QE runoff. We had Treasury issuance. We had rates, Fed removing liquidity from the market, raising rates. We had Treasury settlements, tax date, timing problem in the repo market in terms of cash and investors and cash borrowers. So I think you had a lot of those factors that all kind of came together and created a panic.
But do you think, just to sum up, I get the impression you think, okay, they resolved the situation, they flooded the market with liquidity, they've got themselves in an unfortunate situation because it's now made repo less attractive, so they can't unwind a lot of stuff. But overall, net, most of the problems are under control and solved. And yes, there's a few anomalies caused by Treasury issuance and regulation, but there's no knock-on effects. Would that be right?
Well, yes, that would be right. And I would say there's a lot of problems in the financial markets that can be solved with cash, basically. So, if the Federal Reserve pumps enough cash in the market, we're not going to have any rate spikes, and it's going to pump up asset prices. So I would say, yes, the Fed has solved the immediate problem, but there is a medium-term and a long-term problem because right now they're kind of caught in their own solution, where they used mostly RP operations to pump the liquidity in, And now they're kind of married to that to some extent. Now, of course, the Federal Reserve has a plan, and they're starting to run down the RP operations. And I think that they're going to have a schedule where each month they're going to have the maximum amount of RP operations that are allowed is going to be progressively smaller and smaller. So I think their plan is to run that down. But I think the Fed will not be a laissez-faire Fed going forward in terms of RP operations, where I think that's going to be a regular part of the market going forward, that on month ends and quarter ends, the Federal Reserve is going to announce RP operations just to make sure there's some extra cash in the market.
Perfect. Scott, thank you ever so much for your perspectives. It was super helpful for us all. And I will send you the whole piece once we put it all together, because you'll be able to see all the different people's ideas and viewpoints, because it's really interesting, because we've got a number of different participants in the system, all with different ideas, as you rightly pointed out at the beginning. So great. Thank you ever so much for all your help, and talk soon.
Great. Have a good weekend.
Well, it's interesting there, because I was expecting Scott to be seeing more issues from within the participants. Now, considering how big this issue was, he didn't really have many participant issues at hand, apart from the fact that the banks needed certain funding and reserve requirements, but interestingly, the hedge funds and how they operated. Now, I'm not sure that money market mismatch in terms of timing could have caused everything. To me, it smacks of leverage. It smacks that the leverage players involved in these funding markets maybe had too much leverage on for the situation we found ourselves in, and that was creating a problem. And again, I don't really know what caused that issue, that caused the bottom of the kind of foundations to wobble, but wobble they certainly did. And I think that was one of the reasons the Fed were involved, not just on the timing mismatch, is because the hedge funds, who were the marginal users of capital, were really having problems in securing the capital needed, and they had huge balance sheets. And the market couldn't absorb it because, as we've seen, the banks weren't in a liquidity situation to deal with it. Now, I know there's a lot of people who've been talking about this being, somebody's going to fail. Well, clearly there was issues, but it's not a failure. It's a failure of capital velocity to move around where it's needed because of restrictions and because of the needs of certain players. I really wanted to speak here to Barton Wang. Barton is one of the people I talk to on Twitter a lot. His handle is Barton Options. Now, he for a long time was secretive. He wasn't allowed to be public because of his position at the university, but now he's able to talk more about his view, and he has a really good knowledge and an understanding of how this affects markets. So I really want to speak to him. I'm really looking forward to digging in some more with him on what this all means. Barton, good to finally see the face behind the Twitter handle. Over this whole kind of repo period, you've been one of my go-to people. The other guy is another anonymous person, which is the Games Blazer guy, who I've got to know reasonably well, who's a phenomenal expert on all of this. But you always had really good perspectives. Why do you know stuff about the repo markets and the money markets in general?
Well, thank you for having me first. It's good to be out of the closet finally. Repo market is actually quite an intriguing market to watch, because if you look at what happened in 2018 and 2019, the bank reserve balance, the commercial banks accounts held at the New York Fed, actually led the equity market quite a bit throughout 2018. For half of 2018, it kind of correlated with the equity market movement 50% of the time. And, and it's a number that's predictable. You can forecast how the repo market, how the bank reserve balance will change over time. And that's, in my view, a very powerful tool for me to trade in the equity market. So it just happened that we had a blow up at the end of last year.
Why is the balance sheet affecting the equity market? Because there's a lot of noise about, between QE, the Fed's balance sheet, the Treasury General account, and what it actually does. What is this mechanism that you picked up on?
Yeah, that's a very good question. So the bank reserve essentially served two functions today after we implemented Basel III in 2015. Number one is bank use their bank reserve. That's basically a digital currency, electronic currency at New York Fed for interbank payment. When you pay your bill credit card bill from your Citi checking account to Chase Bank for your credit card bill, there is a commensurate transfer between Citi and Chase at New York Fed. Then the second function it serves is it's the unused reserve balance at New York Fed is essential for financial market to function in the repo market because of how Basel III is written. That is also a overnight or term cash flow. The banks has to be able to have money set aside, in this case, bank reserves, part of the high quality liquid asset, right? They need to set up a certain amount of these assets in order for them to participate in the repo market. So what happened last year was Treasury had 190 billion drawdown from the bank reserve between mid-August and mid-September. And for bank reserve, it's the bank reserve is a aggregate number between 30, 50 different banks, domestically and internationally. It takes a lot of time for the bank reserve balance to reach a new equilibrium over time. If there's a huge disruption, there's a huge drawdown on their balances. So a lot of banks was not able to participate in the repo market once that drawdown happened. And then as a result, you started to see the interest rate on the repo market start to flare up extremely quickly. And so in the downstream, that would affect how much leverage hedge funds can use in their trading, because they're basically posting their collateral, their equities, their treasury bond positions to primary dealers.
Prime brokers and the primary, yeah.
Yes, and they have to have balance sheet capacity to perform such transactions and allow hedge fund to leverage. And essentially, the future market, the option market, both operate implicitly backed by this repo market. So even if you look at the contango of the E-mini future, the S&P, that curve is partially affected by the repo market interest rate.
So therefore, the repo market is the liquidity factor for leverage.
That's true. That's right. Yes.
So when the repo market goes askew, what you're picking up in the equity markets is when there's enough liquidity or reductions of liquidity, you're seeing the amount of leverage that, let's say, the hedge fund system or the leverage players can take increases and decreases. So trades get taken off, trades get put on because of what they're able to do in the funding markets.
That's right. And also in September, when some of the overnight repo rate went up to 10%, for some market participants, you essentially have a situation of certain hedge fund, their overnight position, their funding rate just went up from 2% all the way to 10%, and some of them had to deleverage.
Yes, because they've got a lot of these were the big, and I don't know who was involved, but I'm going to use Citadel as an example. They have huge relative value books, and so when your funding changes from an incremental difference in funding to suddenly goes to 10%, you'll blow up your whole book if it lasts very long. You can give up some profits and manage it for a day or two, but if it's a sustained difference in funding level, it's you've got a big problem.
That's exactly right. And also, if there is a sustained equity market movement, then your book started to have a larger and larger margin requirement if it happens that the market is running against you, and that could trigger a positive feedback of funds has to liquidate their position, which triggers even more liquidation because the repo market is locked up.
So therefore, following your line of thought, therefore this massive injection of liquidity by the Fed, the equity market rally is a direct consequence of that.
To a certain extent, yes, because the Federal Reserve has been injecting liquidity not in a very fine-grained way, just supplying the liquidity that's needed by the market. They are trying to err on the safe side, so they're over-providing liquidity to the market, probably by 150 to 200 billion as we speak now. And I don't think hedge funds are sitting around waiting to see what that liquidity is doing. I think people are leveraging up because of the existence of these liquidity. So that's definitely fueled the equity market rally. And it's a positive feedback too. The more it rallies, more people want to.
It's kind of Pavlovian as well in how it operates. And, even if it doesn't actually have even if it's a placebo effect, it still works.
That's true, yes.
So here we are now. The Fed are now almost permanently going to be in some sort of action, whether they've got a standing repo facility or whether they start switching and running down this and moving out to 2 years. What the hell is their game plan, and why are they still involved?
I think Fed is just still trying to be on the safe side. They kind of screwed up and lost face in September, and they don't want to repeat that mistake again. So they are trying to just oversupply the market with liquidity. They're not super concerned with how equity market is going. They're more concerned with short-term interest rate movement. So to them, I think injecting liquidity a little bit over what's needed is not a huge issue. But I think the interesting dynamic right now is that because Fed has this reaction function that's relatively slow and they overreact, the Treasury General Account, TG account, has an oversized influence on where we're going. So for example, last Friday, Treasury Secretary Mnuchin hinted that he might increase the Treasury General Account balance to maybe 600 billion, and that will definitely force New York Fed's hand. They may have to run their T-bill purchase program for an extra 3 months or something. And at that point, the Treasury can have a lot of degree of freedom to release that liquidity anytime they want. So for example, before election, if they wish, they could dump 200, 300 billion of liquidity into the market in a month. I'm not saying they're doing it. I'm just saying they will have tons of ammo. Basically, they can do what Fed was doing, QE, in a very short period of time, in a month that what Fed typically would do in 3 months. So it's an interesting dynamic we're seeing right now.
Right now, the global economy is slowing down. The coronavirus is not something we'll talk about much today, but it is another huge impact, I think, on the global economy. The US economy, we saw some Chicago numbers out today and others, looks weak. So in a weakening economy, how does this all follow through? Are the Fed still able to levitate the equity market, which we've kind of seen it's decoupled from most things? Does that money flow into the bond market? I mean, because that's what I'm seeing now. I mean, bond yields are collapsing at an incredible rate. What's your view on all of this?
Yeah, it does. It does flow into the bond market. But this is a very important question. The thing I think many people probably don't recognize at this point is that the liquidity that flows into the repo market can either be leveraged by hedge fund for their equity position or bond position or credit positions, but also can be used by big banks for their Eurodollar positions. So that could also be used for increase the supply of Eurodollars, offshore dollars outside of the United States. And that could have a huge impact on the foreign exchange rate, which could actually have an adverse impact on equity. If the US dollar crashes, then a lot of the European and Japanese pension fund insurance companies who have piled onto US equities in the past 2 years probably will not be so comfortable, especially if some of them, their books are not hedged at this point.
Yeah, the question is whether that can happen yet, whether we've got the structure in place for that to happen. Because as far as I'm aware, most of domestic, if there's a domestic funding shortage, which is still the case, even though it's oversupplied, there's still some issue with funding shortage. Therefore, the relative propensity of a US domestic bank to lend in the Eurodollar market is less because they don't have as much. The Eurodollar market, the Basel III basically created Eurodollars and domestic dollars as non-fungible instruments. So I'm not sure whether it can flow from one to the other on a standard mechanism. I don't know what you think.
So one thing that's interesting about Basel III is that Eurodollar before Basel III has no balance sheet constraint in terms of how the bank reserve operates in New York Fed. Like you can just have beyond 20x leverage on your Eurodollars. There's no regulation on capital requirement before. But after Basel III, Eurodollar transaction, if it's between different banks, will have also a commensurate transaction on New York Fed's book. So that cash flow will show up and has to be satisfied in terms of LCR ratios for the big banks. So they are now constrained by the bank reserve level they have. And it has been that way since 2017 when the Basel III was 80% implemented.
And that's one of the things that's put the European banks under pressure, is that inability to access dollar funding.
That's true, and also that has changed the dynamic between Eurodollars and the repo market, and also the cross-currency basis in the past 2-3 years. It's quite different from what it was 5-6 years ago.
I pick up that the Fed need to steepen the yield curve. Do you agree with that?
A steeper yield curve helps foreign buyers, including pension fund, insurance companies, to invest in U.S. Treasury bond, essentially. At this point, when everything is inverted, all of the purchasing power moves to the front end of the risk curve, right? So so that is not helpful because that causes the lack of purchasing power, or nobody wants to buy long end U.S. Treasury. And as a result, it skews the book of the primary dealers, and they have to digest. They have to basically hold all these long end U.S. Treasuries and essentially lock up very valuable balance sheet space for them. So it's a logjam of U.S. Treasury bonds on the primary dealers book caused by this curve inversion.
So the Fed really, to help free up the markets overall, probably need to steepen this curve. Does that not lead them to cut rates?
At this rate, they probably have to cut rates at some point in the next 2 years. It's really difficult to keep the rate at this level while the government is running so much deficit, and we have other things, risk going on in the world, like the coronavirus and so on. So since the Fed does not control the long end of the curve that much, and then they have a very strong incentive to steepen the curve, then they probably will be forced to cut interest rate sometime pretty soon.
And so I want to go back to just a little bit to cover on your idea that once there's the liquidity, it flows into, and we talked about it could be into equities, it could be into bonds. How do people know when to make that decision? Because I'm a business cycle guy, right? So me, I'm all about bonds right now, and I don't really care about equities because I think there's this kind of mechanism that makes them a bit screwy for me. They're not very good macro variables, but a bond is a particularly good macro variable. So if I'm getting the acceleration from excess money that the Fed's putting in and it's going into the bond market, right, I'm going to get all the juice. If you were a long player in the equity market, in better economic times, you make a huge amount of money out of that mechanism. How do you think about that?
That's a very hard question. I don't have a good answer for that, actually. I'm more of a monitor of that development. I don't know why people do certain things at certain months, why there's a difference in flow between one market versus another. It's a mystery to me as well. I just keep watching it, and it's, yeah.
The bills are going to start rolling off. They already have. So the balance sheet is actually shrinking currently. Is it? You're looking like, I don't know.
It's still increasing. Some of the repos are maturing, but the speed of repo maturing is slower than the speed they buy new T-bills.
Okay, so the balance sheet's still going up, but the rate of change is falling. Is that right?
Yeah, it's like a plateauing.
That's right. Sorry, I was talking about rate of change. Under your kind of model, does that put pressure on the equity market? Or does rate of change not matter? Does it need to be absolutes?
It all depends on what Treasury will do. Treasury has so much cash in their account, they can flood the market with $40 billion anytime they want. So I think they introduce, if we look at the realized volatility of the total aggregate bank reserve levels, Treasury, their action is the biggest contributor to the volatility. Fed has been doing this very smooth ramp up, and they communicate everything months ahead of time. Treasury, not so much. They communicate maybe a week ahead of time when they change direction. There's supposed to be a refunding quarterly announcement next week, but that's just a soft target. They can do whatever they want, essentially.
So is Mnuchin essentially using this as an economic weapon in his ability to try and micromanage the economy and sidestep the Fed? Is that what he's doing?
I don't know what he's doing. I would say he has a lot of ammo to do that if he wants to pursue that direction. And what Treasury has been doing looks very suspicious to me as in terms of forcing Fed's hand And they have been very effective in doing that. I don't know what exactly his plan is. Maybe we should ask him about it in some of his press conferences.
Yeah, I agree. I think it's interesting. It feels to me that we know there's a disconnect between the Fed and the government, and it feels that Mnuchin's kind of figured out that he's got the big checkbook, and if he decides he wants to put more in his checking account, there's nothing the Fed can do about it without blowing up the markets.
I think the way the Treasury General Account has been managed in the past 3 years is completely unprecedented. I've never seen the TGA going up and down in such a rapid fashion since the financial crisis.
So people need to start watching that more as opposed to the Fed balance sheet. That would be your tip from this whole thing.
Right. Fed balance sheet is actually pretty boring, right? It's a very slow, gradual process. Except for maybe once a year, they will do something. They will change direction very drastically. But other than that, it's a pretty slow, smooth process.
So the Treasury General Account is the marginal liquidity provider or taker away of liquidity. And that's the one that can flip quickly, the thing we need to keep our eye on.
Yeah, they triggered the September repo crisis, right? That's exactly what happened.
That's exactly right. Barton, listen, thank you ever so much. It was really good to get your perspectives on all of this and how you think it through. I think it's a really unique way that you're looking at it. You've got a very kind of dynamic model. I think that's very unique and really interesting.
Thank you for having me. It's always fun to chat with you.
Well, Barton didn't disappoint. He really has a nuanced understanding of this and the issues involved, how there is a mechanism between these simple technical factors and the realities that happen in the markets. Now, not all of it is just related to the Fed balance sheet. I do think there's a Pavlovian response that's embedded within that kind of placebo effect, as it were. But it's that Treasury General Account that really took me by surprise. That seems to be the nuclear weapon that's here in the money markets. That is the marginal player. If we thought about the marginal liquidity player being the hedge funds, in terms of taking liquidity, the marginal liquidity provider is the Treasury General Account. So that is probably the tension we're seeing here. As the Treasury takes bills out of the market to replenish itself, it takes money away from the hedge funds and they're desperate for cash. And it's not desperate for cash in terms of money being redeemed, it's just the funding needed for all the trades and the businesses they do. The more complex and complicated the relative value hedge fund, the more implicit leverage they will have. So I thought that was a really, really fascinating opinion that he had. And I think that money market wobbles and the use of that Treasury General Account are going to be something we need to get used to going forwards. We're going to have a better understanding of what it means. I also liked the idea that money can flow depending where the return is, depending what's happening in the economic backdrop. That helps me understand that there's certain times money doesn't necessarily flow into equities that can flow into bonds. Let's wait and see if that proves out to be the case, because the equity market decoupled from economic fundamentals back in the last quarter of last year as this money ripped through the equity markets and caused the bubble that I was talking about. These markets really are complicated. They're so complicated the Fed doesn't really understand what's going on, and as you can tell from all of these skilled experts in the space, nobody truly understands why things are moving as they are. Regulation plays a big role. Regulation was truly necessary, but now we have bizarre things where a dollar in Europe is not the same as a dollar in the US, where the European banking system can have a liquidity crisis in dollars and then suddenly the US banking system can. For me, it tells me there's not enough dollar liquidity in the world. It's wrapped up in things like reserves, and it's not where it needs to be. So again, if I think of the world in my framework, what does that mean for the currency markets? I know Barton thinks, well, there's a potential dollar collapse here, and I think that's possibly the case, but in the future. It tells me you can't get dollars when you need them, and that makes dollars very valuable. So I hope you enjoyed the deep dive here. Looking forward to doing many more of these in the future. There'll be me and several others taking you on that journey of understanding where we can really get to grips with what's going on the issues that matter when they matter.